The silver price is lying to you right now, and the spread is telling the truth. Because while everyone is staring at the headline candle and calling it profit-taking, there as a mechanical force hitting the market this week that doesn't know to care what you believe, and it's colliding with a physical setup that doesn't unwind on a schedule. And here is the payoff. By the end of this video, you'll now have 3 specific signals to watch over the next 1 to 2 weeks. The levels that matter, and the one hidden mechanism that can turn a scary pullback into the exact kind of move that launches the next leg. Silver is sitting around the mid to high 70s per ounce right now, after ripping into record territory and then snapping back hard. You felt it. That whiplash is the point. Reuters was already pointing to silver around $76 or $77 as investors positioned for index adjustments and a stronger dollar, with the market still digesting the aftershock of a massive run. And that index adjustments phrase is doing a lot of work because it's not a vibe, it's not a mood, it's math. And when math hits thin liquidity, price can gap like it's stepping off a curb you didn't see. Here is the core conflict. The mainstream explanation says silver dropped because traders took profit after a huge rally. Sure, that's always part of it, but it's not the driver that matters right now. The driver is that big commodity benchmarks rebalance in early January, and one of the most tracked ones is scheduled to run from January 8 to January 14. That rebalancing forces funds to change their futures exposure. Not because they suddenly turned bearish, not because they saw a headline, because their mandate says, you must. And JP Morgan's own estimate floating around the street says the forced selling in silver futures could be on the order of a few $1 billion. Silver, not oil. Silver, not copper. Silver. And silver is a smaller, thinner market than people emotionally price it as. That's where the real pressure starts. Now zoom in. Forced selling in futures is not the same thing as the world has too much silver. It's not even the same thing as investors don't want silver. It's a flow, a timed flow, a scheduled shove. Imagine a crowded hallway where someone yells, move left, and 100 people shift at the same time. That doesn't mean the building is collapsing. It means the hallway got chaotic. And in markets, chaos prints as price. Especially in a market with leverage, with options, with margin, and with liquidity providers who will step back the moment they smell risk. And here is the underappreciated detail most people miss. The most violent moves often happen, not during the forced selling, but right after it ends, when the temporary pressure disappears, and the market has to reprice based on what was underneath. That's why this matters if you own silver. Because if the market can absorb a mechanical billion-dollar shove and still hold key levels, that's not weakness, that's demand showing up under stress. But that's not the part that matters. The next detail is what flips the whole setup. To understand silver right now, you have to separate the paper market from the physical market without falling into cartoon conspiracy thinking. This is about incentives and structure. Futures set the headline. Over-the-counter trading in London sets a lot of the benchmark settlement plumbing. ETFs and ETPs create a bridge for big pools of capital. Industrial buyers source metal with lead times, contracts, and logistics constraints. And all of that meets at one place, the spread, the curve, the cost of getting metal now versus later. Because in commodities, the truth is often in the time dimension, not the spot print. When people say the price is down, what they usually mean is the front-month futures price or spot. But the curve can be screaming something else. If near-term metal is scarce, the market can go into backwardation, where near-term prices trade above later delivery. That's not a moral judgment. It's the market charging you for immediacy. It's the market saying, if you want it now, pay up. And even if the screen price drops for a few sessions because of forced rolling or index selling, backwardation or elevated lease rates can tell you physical is still tight. That's the whisper underneath the shout. And we have reasons to take that whisper seriously. Start with the balance sheet. The Silver Institute World Silver Survey 2025 reported another structural deficit in 2024, about 148, 9 million ounces, with industrial demand hitting a record around 680, 5 million ounces. That's not a meme statistic. That's the kind of number that tells you the industrial bid isn't just speculation, it's consumption. And deficits matter because silver is not a market that can spin up supply in a quarter. A lot of silver comes as a byproduct from other mining, lead, zinc, copper. That means silver supply is constrained by economics that have nothing to do with silver ES price today. If silver doubles, you don't automatically double supply. You get some recycling response, you get some marginal projects, but you don't get a faucet. And that's where the real pressure starts. Now layer on the global plumbing. The London Bullion Market Association reported that silver held in London vaults was about 27,187 tons at the end of November 2025, up on the month. People see that and think, great, plenty of metal. But the number alone doesn't want to tell you what's actually available for settlement at the margin. Vault holdings can rise while the free float shrinks because bars can be owned, pledged, earmarked, and strategically positioned. The question isn't, does silver exist? The question is, where is it, and can you get it where you need it, when you need it, without paying a spread that blows up your model? That location issue is not theoretical. Goldman Sachs' commentary this week was blunt. Silver's problem may not be a global shortage, but that metal is stuck in the wrong places, with inventory dynamics shaped by policy uncertainty and the movement of metal into U.S. vaulting systems. The implication is nasty. If the benchmark pricing hub is tight while metal is parked elsewhere, you get regional stress, you get volatility, you get wider spreads, and you get a market that can rip up and down with less and less volume. It's not the quantity, it's the distribution. And that's the hidden detail that makes a normal pullback dangerous for shorts and painful for weak hands. Now add the third layer, margin. If you watched silver at the end of December, you saw another structural weapon get pulled, not by a shadowy villain, but by risk management. Reports in the financial press described CME margin requirements being increased on silver futures, which forces leveraged players to post more cash or reduce positions. When margin goes up, it's like gravity increasing. People who were fine yesterday suddenly aren't fine today. They sell what they can sell, not what they want to sell. That triggers more selling. Liquidity thins. Stops get hit. And then, this is key, after the washout, the market can rebound violently because the weak leverage has been removed. This is why silver doesn't move smoothly. It doesn't need a conspiracy to be savage. Leverage and margin are enough. So now put the pieces together in real time. Early January gives you the index rebalancing window. That creates forced selling and rolling in futures. Late December gave you margin stress, which shakes out weak leverage. The physical market is dealing with distribution imbalances, with London and US vaulting dynamics in focus. Industrial demand has been running strong enough to print record levels recently, with multi-year deficits, and the price is sitting around $76, $77 after a violent move. If you're feeling anxious, good. The market is designed to make you anxious right before it reveals its next hand, because if this one level breaks, the math changes. Let's talk about that math in plain language. Futures or leveraged contracts. Many participants don't intend to take delivery. They roll or cash settle. But the delivery mechanism anchors the contract to reality. As you approach delivery windows, the cost of sourcing deliverable metal matters more, and not all inventory is equal. In the US system, I'll hear people talk about eligible versus registered stocks, metal that meets specs versus metal that is actually registered for delivery. You don't need to memorize the categories, just understand the incentive. Metal that is eligible might be owned by someone who has no interest in delivering. Metal that is registered is closer to the pipeline. When that pipeline tightens, the curve reacts. The spread becomes the message, and that message can precede the spot move. Now, you might be thinking, okay, but if index funds are selling billions, doesn't price have to go down? No, price has to clear. That's different. If there is enough underlying demand, physical, hedge demand, institutional rebalancing the other way, short covering, then forced selling can get absorbed. And when forced selling gets absorbed, it becomes information. It tells you there are bigger hands willing to take the other side. That's not a guarantee of an immediate rally. But it changes the probability tree. This is where silver becomes a chessboard instead of a roulette wheel. Because the players are different. Passive index money trades on schedule. Dealers hedge options and manage gamma. CTAs chase trend signals. Miners hedge production. Industrial users hedge costs. ETFs adjust holdings based on inflows and outflows. And retail buys coins and bars when their fear spikes. Everyone thinks the news moves the market. In reality, it's the interaction of these flows. And when they collide near key levels, the tape can do something that looks irrational but is perfectly logical. So let's pin down the battlefield. With silver hovering in the mid to high 70s, you're watching a zone where the market is deciding whether the recent breakout was real or just a blow-off. Think in ranges, not single numbers. The mid-70s area is the battlefield. Above that, the market can stabilize, consolidate, and set up a retest. Below that, you risk a deeper flush that turns a pullback into a full reset. On the upside, the low 80s area becomes a gate. If price reclaims and holds that region after the forced selling window passes, it tells you the market is willing to pay up again, even without the adrenaline of the initial spike. And the record zone above that becomes the panic line, the line where shorts start to feel the oxygen thin, where hedges get chased, and where reflexivity can take over. But that's not the only signal. In fact, it's not even the best one. The best signal is whether the market's internal stress measures relax or intensify while price chops. Watch how silver behaves on down days. Does it bleed slowly and drift lower on heavy volume? Or does it slam down and then get bought back aggressively? The second pattern, sharp flush, fast reclaim, often means forced sellers are hitting bids that don't move. Someone is standing there, and that's where the real pressure starts. Now we need to address something important. The paper versus physical conversation attracts people who want a simple villain. Don't do that. The credible version is incentives. Futures and OTC markets are where hedging happens. They're where liquidity concentrates. They can be pushed around in the short run by big flows. Physical tightness shows up through cost of carry, through spreads, through lease rates, through regional premiums, and through delivery behavior. You can acknowledge that these markets can disconnect at the margins without claiming the whole system is a fraud. The key is to know which signals lead. Here's a simple way to think about it. If the screen price drops but physical premiums don't relax, that's a mismatch. If the curve stays tight while spot chops, that's a mismatch. If ETF holdings aren't at extremes but price is moving like a stressed market, that's a mismatch. Mismatches don't last forever. They resolve, and they usually resolve in the direction of the constraint. That doesn't mean straight up. It means the market eventually reprices to clear the tightest bottleneck. And right now the bottleneck is not lack of interest. It's distribution, liquidity, and timing. Timing matters because this isn't just this month, it's this week. January 8th to January 14 is a known window for commodity index rebalancing flows. Traders know it, dealers know it, funds know it. That means people position around it. Some will front run the selling, some will fade the panic, some will step away and let it pass. That creates a very specific type of market, one that can look weak on the surface while being quietly accumulated underneath. And that's why the next 1 to 2 weeks matter more than 1,000 hot takes. So what's the hidden detail that reframes everything? It's this. A mechanical seller is not a smart seller. A mechanical seller sells because they must. If the market holds up anyway, it means the natural bid is stronger than the mechanical shove. And when that mechanical seller is gone, the natural bid can reassert itself quickly, especially if there are shorts or hedges positioned for a breakdown that never arrives. That's when you get the move that feels like it came out of nowhere. But it didn't. It was built while everyone was distracted, because if this one level holds, the math changes. Now let's talk about the squeeze mechanics without turning it into fantasy. A squeeze doesn't require a cabal. A squeeze requires positioning, leverage, and a trigger. The trigger can be a breakout through a level. It can be a spread blowout. It can be a policy headline that changes availability. It can be a sudden drop in liquidity. The reason squeezes accelerate is risk management. When price moves against a leveraged short, margin requirements rise, losses rise, and the broker doesn't care about your thesis. The broker cares about collateral. So the short buys back. The buying pushes price higher, which forces more buying. Reflexivity, it's ugly. It's also normal in leverage-driven markets. And silver is built for reflexivity because it sits at the intersection of investment narrative and industrial reality. Industrial buyers don't get to wait for confirmation the way retail does. If you make electronics, or solar components, or specialized alloys, you manage supply risk. You hedge. You secure inventory. You diversify suppliers. When the market gets jumpy, procurement gets defensive. And defensive procurement is not emotional. It's operational. That's why industrial demand is a different animal than speculative demand. It doesn't vanish because Twitter got bearish. Now let's anchor proof. Proof point 1 is price behavior itself. Silver around 76 or 77 after a record and a violent pullback, with the market still up meaningfully early in the year. Proof point 2 is the calendar. The index rebalancing window is public, and estimates of multi-billion-dollar selling are in circulation from major banks. Proof point 3 is margin. Silver just experienced a late December shock tied to higher margins, which is exactly the kind of event that flushes leverage and sets up a more stable base. Proof point 4 is fundamentals, multi-year deficits, and record industrial demand in the latest survey data. Proof point 5 is physical distribution. Commentary highlighting the wrong places problem in LBMA vault data that underscores how important London custody remains. Proof point 6, if you want it, is the policy risk. When trade policy or export licensing uncertainty rises anywhere in the chain, commodities become more regional and less liquid, which amplifies moves. You don't need to know the exact policy detail to understand the mechanism. Uncertainty fragments flows, fragmentation widens, spreads, and wider spreads destabilize the headline price. But there's a counterpoint you need to respect because credibility matters. Silver can fall hard even if the long-term thesis is correct. If physical metal moves back into London from elsewhere, tightness can ease. If the dollar surges and real yields spike, metals can get pressure. If risk assets wobble and funds need liquidity, silver can be sold as a source of cash even when it's supposed to rally. And if the market simply overshot and needs time to digest, you can get a grind lower that feels like betrayal. So don't confuse trend signals with noise. Don't let 1 week define a multi-month setup. And don't let a thesis turn into stubbornness, because silver is a market that punishes certainty. Here's how you protect yourself psychologically. The market will try to manipulate your emotions with volatility, not with logic. It will show you a vertical rally and make you feel late. Then it will show you a violent dump and make you feel stupid. Then it will bounce and make you chase. Then it will chop and make you quit. That cycle is not accidental. It's how liquidity is harvested from impatient participants. So decide right now what game you're playing. Are you a long-term holder hedging currency stress? Are you a swing participant watching levels? Are you a trader managing risk tightly? Different game, different rules. If you don't pick the game, the market picks it for you. And that's where the real pressure starts. Now let's build the two scenario lens, because this keeps you sane. Scenario 1 is the controlled pullback and retest. In this scenario, silver holds the mid-70s battlefield zone, churns through the index rebalance window, and then attempts to reclaim the low 80s gate. You'll see volatility, but the damage will be contained. The curve and spreads will not fully relax, and dips will get bought quickly. Confirmation looks like intraday flushes that get absorbed in a market that can rally even when headlines are neutral. Scenario 2 is the continuation squeeze and gap risk. In this scenario, the forced selling ends. Price reclaims key levels, and shorts or underhedged participants get chased. The tape accelerates, pullbacks become shallow. You get overnight gaps. You get the feeling that you can't get in cleanly. Or confirmation looks like reclaiming the low 80s zone and holding it, strength into thin liquidity, and persistent tightness signals in the curve that refuse to cool. Both scenarios can happen with pain. Scenario 1 hurts the impatient because it's boring and violent at the same time. Scenario 2 hurts the cautious because it feels too fast to trust. That's why you need a checklist, not a prediction. A checklist. So here are the 3 signals to watch over the next 1 to 2 weeks that will tell you whether this move was a reset or the ignition. First, watch the post-rebalance behavior after January 14th, not during the chaos, after it. Does silver keep sliding even when the mechanical selling should be largely done? Or does it stabilize and start to lift as the forced flow fades? The market's reaction after the known event is more informative than the event itself. Second, watch the dollar and rates impulse around major U.S. data, especially the jobs report. Metals can get hit if the dollar strengthens sharply and rate expectations shift. But if silver holds up even as the macro headwind blows, that's information. That's the market telling you the bid is not just speculative froth. Third, watch the stress signals. The curve, the spreads, the availability feel in physical markets, and the way price behaves around key levels. If spot dips, but the market keeps snapping back and tightness doesn't fully unwind, the setup remains alive. Now let's talk levels again, but in the right spirit. Levels are not magic lines. They are zones where risk managers make decisions. The mid-70s zone is your battlefield. If you see decisive acceptance below that zone, meaning price breaks, fails to reclaim quickly, and liquidity feels one way, that weakens the squeeze narrative in the near term. It doesn't kill the long-term structural story, but it says the market needs more time. On the upside, the low 80s zone is the gate. A clean reclaim and hold, especially after the rebalancing window, tells you the market is willing to reprice higher without forced buyers. And the record zone above that is the acceleration zone, where the market's memory of pain forces hedges to respond. Because if that gate opens, the math changes. Now, there's a subtle but important nuance. A lot of investors will look at the rebalancing story and say, so I'll just wait until after it's done. That's logical, but markets front-run logic. If everyone waits, the turn can happen earlier. If everyone buys the post-event rally, the market can fake you out with one more flush. That's why you don't time silver with certainty. You manage it with rules. You scale. You respect invalidation. You expect whipsaw. And you refuse to make emotional decisions based on a single candle. Let's also address the paper suppresses price narrative carefully. It's true that futures markets can temporarily distort spot. It is true that large flows can push price in ways that don't reflect immediate physical conditions. But it's also true that over time, physical constraints win because they force behavior. If immediate metal is tight, someone pays up. If distribution is fragmented, spreads widen. If margin rises, leverage flushes. If industrial demand persists, procurement hedges. These are mechanisms, not morality plays. And mechanisms are what you can trade psychologically. So what would actually invalidate the near-term bullish pressure story? A few things. If silver breaks down from the battlefield zone and stays there with rebounds weak and quickly sold, that's a warning. If macro headwinds intensify and metals start to correlate with risk-off liquidation, that's a warning. If tightness signals relax meaningfully, if spreads normalize, if the market stops paying for immediacy, if physical premiums soften broadly, that's a warning. And if you see a sustained return of metal to the benchmark hub that eases distribution stress, volatility can compress and price can retrace more than people expect. None of that is doom. It's just the market moving from one regime to another. The danger is pretending one regime is permanent. Now let's bring it back to you, the viewer, and your next decision. If you own silver, you're not just making a bet on a number. You're making a bet on a regime, a world where debt, geopolitics, and policy uncertainty keep hard assets relevant, and where industrial electrification keeps silver demanded even when investors get shaky. But in the short run, you're dealing with a market that can be pushed around by scheduled flows and risk constraints. That's why your edge is not bravado. Your edge is clarity. You know why it's moving. You know what to watch next. And you know what would change your mind. Here, and too much the part people don't want to hear, the market is going to try to use volatility against you. If silver pops, you'll be tempted to chase because you'll fear missing the squeeze. If silver dumps, you'll be tempted to panic because you'll fear being the exit liquidity. Both impulses are the same emotion wearing different masks. The antidote is simple. Separate your time horizons. If you're a long-term holder, you measure your thesis in weeks and months, not hours. If you're a swing participant, you define your levels and your risk before the move happens. If you're trading, you accept that you can be right and still get stopped out because silver is violent. And you never size a silver position like it's a bond, because silver is not a bond, it's a storm. So what happens next week? Expect the tape to stay jumpy through the rebalancing window. Expect liquidity pockets where price moves farther than it should. Expect headlines to give you reasons after the fact, and then watch the market's behavior after the known mechanical flow is passed. If silver stabilizes and starts to reclaim the upside gate, that's your signal that the market absorbed the shove and is ready to reprice. If it fails and slips below the battlefield zone with weak rebounds, that's your signal the market needs more time and more cleansing before the next push. And here, it's the final thought you need to hold on to. If silver is truly in a regime where distribution stress and structural deficits matter, the biggest moves won't happen when everyone feels comfortable. They'll happen when people are exhausted. They'll happen right after a flush. They'll happen when the narrative says, it's over. And then the spread will widen, the tape will lift, and suddenly the market will act like it can't remember why it was scared. Because the forces underneath never left. They just got masked by the calendar. If you're still here, you're not here for hype. You're here because you want to understand the plumbing, the incentives, and the real-time signals, so you don't get shaken out by the exact volatility designed to shake you out. Stay close to the mechanics, not the mood. And over the next 2 weeks, don't ask, is silver bullish? Ask the better question. Did the market absorb the forced selling? And did the tightness signals refuse to relax? Because if the answer is yes, the next move won't need your permission. It will just happen.